Hey everyone, welcome back to Corporate Decoder, where we untangle the confusing world of business for you today. We're diving deep into AptarGroup's earnings report, a company that makes all sorts of cool dispensing stuff for things like medicine and cosmetics. And believe me, this report spills some serious tea on their performance. Let's jump right into the numbers for the second quarter of 2025. AptarGroup raked in $966 million in sales. That's up from $910 million in the same period last year, a nice 6% jump. Their total operating expenses were $821 million, leaving them with an operating income of $144 million, which is also up from $126 million last year. But here's where it gets interesting for us as investors. Basic earnings per share came in at $1.69 for the second quarter of 2025, up from $1.36 last year. And on a diluted basis, it's $1.67 compared to $1.34. That's a solid jump, showing they are earning more for each share they own. Now let's look at their financial health. As of June 30, 2025, AptarGroup had total assets of about $4.8 billion and total liabilities of around $1.3 billion. That means they have more assets than liabilities, which is generally a good sign their stockholders' equity. The value belonging to the owners is a healthy $2.7 billion. However, they are carrying some debt. Their revolving credit facility and overdraft sit at $64 million, and their long-term obligations are another $535 million. This increases their total debt to over $1 billion. While they have cash and investments to cover this, it's something to keep an eye on, especially with interest rates going up. The company spent $1.6 million on restructuring initiatives in this quarter. This is basically money spent on making the company more efficient, maybe closing some plants or cutting costs. It's a significant amount, but they're also seeing benefits from these moves. Getting back to sales, we saw a 3% core sales increase. This means that even after you take out the effect of currency changes and any new acquisitions, their actual business from existing operations grew. This growth was across all three of their main segments: Aptar Pharma, Aptar Beauty, and Aptar Closures. That's a good sign of broad-based health. Aptar Pharma really led the charge here. Net sales went up 7% and their core sales grew 3%. This segment is crucial for them, serving drug delivery and health markets. Prescription drug sales were particularly strong, driven by demand for emergency medicines and asthma products. They also saw a nice boost from customer royalties, which is essentially earning money from other companies using their technology. That segment truly shows their strength. Aptar Beauty had a more mixed performance. Net sales were up 4%, but core sales only grew 1%. They are seeing good sales in hair care and body care products, but the prestige fragrance market is a bit soft. Maybe because customers are worried about tariffs affecting prices. Their beauty market decreased 7%, which is a concern. The personal care part of this segment is doing well, though showing 11% increase. Aptar Closures showed solid growth with net sales up 8% and core sales up 7%. This segment benefits from strong demand in food and beverage applications like sauces and condiments, and beverages like functional drinks. Those are everyday items, so demand is usually steadier. That part of their business is performing quite well. Now let's talk about profitability. AptarGroup's adjusted EBITDA margin, which is a way to measure their operating profit before certain costs like interest, taxes, and depreciation, was 22.6% overall. That's up from 21.2% last year, showing they are becoming more profitable. Aptar Pharma is their star performer with a 35.4% margin. Aptar Beauty's margin is lower at 14.1%, and Aptar Closures is at 16.9%, showing higher profitability in the pharma business. Looking at their debt, again, their net debt to net capital ratio increased slightly to 25.2%. This means that for every dollar of capital they have, they owe about 25 cents in debt. It's not alarmingly high, but it has gone up. This reflects their borrowing from the new term loan and revolving credit facility. Now, for free cash flow, which is the cash left over after operating and investing activities, AptarGroup generated about $91.7 million in free cash flow in the first 6 months of 2025. This cash can be used for dividends, share buybacks, or new investments. This number is pretty stable compared to last year, which shows consistent cash generation. Regarding risks, AptarGroup is facing a few lawsuits and claims they mention. intellectual property disputes and commercial challenges. They believe these won't hurt the company much, but there's always a risk of unexpected outcomes. And they are also dealing with some tax assessment claims, which could mean penalties and interest. However, they haven't recorded a liability for these yet because the outcome is uncertain. Looking ahead for the third quarter of 2025, they expect earnings per share between $1.53 and $1.61. It's good to see they are giving a forward-looking view. They also plan to spend between $270 and $290 million on capital expenditures. This shows continued investment in their facilities and growth. Now, for my take on Aptar Group, based on this report, they seem to be doing pretty well. Their core sales are growing across the board and their pharma segment looks particularly strong. The increased profitability shown by their adjusted EBITDA margins is a very positive sign. Their debt is manageable, but the slight increase is something to monitor. The beauty segment needs a bit of attention to see if they can turn around those softer trends, but overall, the company seems to be navigating the economic landscape reasonably well. They are investing for the future, which is good to see, but also facing some typical business risks with lawsuits and tax claims. It's a solid but not spectacular quarter. They are definitely on my radar as a company focused on efficiency and growth. What are your thoughts on Aptar Group's latest report? Do you think their beauty segment will bounce back? Let me know in the comments below. And if you found this breakdown helpful, please smash that like button and subscribe for more corporate deep dives. Don't forget to join our Discord community, linked in the description. To keep the conversation going, thanks for tuning in to Corporate Decoder. See you next time.